There's a chart in your book, Chapter 10, that contrasts the three methods of depreciation, showing its effects by year. They do result in different dollars of depreciation expense. Straight line, the same amount each year. Double declining balance is an accelerated method. It doubles the rate of straight line, but it's based on the declining book balance of the asset. And so it starts high and it decreases low. Again, double declining balance is known as an accelerated method. It gives you more depreciation expense in the early years than in the later years. Again, straight line, depreciation expense per year on one axis, years over the other, same amount per year. If you graph the dollar amount of depreciation by year, it gives you a straight line. Whereas double declining balance, depreciation is accelerated, meaning more depreciation in the early years of life and less in the lower years of life. Any of the methods, be it straight line, double declining balance, or unit fraction, despite the timing of depreciation expense, all methods have the same amount of total depreciation over the useful life of the asset. Why? Because they're all expensing what's called that depreciable cost. So again, irrespective of the method of depreciation, they're all expensing the depreciable cost. Original cost less any estimated residual or salvage value. Different timings per year amount, but over time, the total depreciation expense is the same for all methods. I'll call your attention to a section of the textbook about spending on an asset after its initial acquisition. An expenditure that's called a capital expenditure debits the asset account, not expense. Capital expenditures are major repairs which increase the asset's capacity or extend its useful life. An example would be a complete overhaul of a motor, which may extend its life or even its capacity. That is a capital expenditure. It's not expensed. It's charged to the asset account as incurred. Versus what? Versus something called a revenue expenditure. These are normal repairs. We debit repair and maintenance expense account as they're incurred. The revenue expenditure is an income statement expenditure. It's expensed as incurred because it only maintains the asset in working order. It does not increase the capacity or extend the useful life as a capital expenditure would. Be aware of these terms and understand their implication as to where the expenditure is charged. Asset account, capital expenditure because we're extending the useful life. Revenue expenditure, charged to expense. It's only maintaining it in working order, not increasing the useful life or its capacity itself. Just to illustrate the effects in the balance sheet, when an asset is purchased, acquired, cash goes down, the asset goes up, a capital expenditure. If later there is a major overhaul to that asset, cash goes down, the asset value is increased. That's called a capital expenditure. Because we're debiting the asset account after acquisition because we're increasing the utility of the asset. Contrasted with what? Routine maintenance. Spend cash, it's expensed. We debit maintenance expense, called a revenue expenditure because it affects the income statement immediately upon spending as expense, not as a debit asset. Know these two terms in your textbook. So the initial acquisition is called capitalized, and later expending, if it's a major one, it's called a capital expenditure. If it's a routine expense, revenue expenditure.